Welcome back to Seven Hills Equities. Today we're diving into 5 stocks worth considering in September 2025. These aren't speculative flyers, and I'm not telling you to run out and buy them. Instead, think of this as a lineup of companies with strong foundations, consistent earnings power, and valuations that deserve a closer look right now. As always, this is for educational purposes only, not financial advice. Let's jump in. Number 5. United Health Group, ticker UNH. United Health is a juggernaut in healthcare. Between its insurance division and its Optum Health Services business, it has massive recurring revenue, huge cash flow, and deep roots in an industry that is non-cyclical. Over the past 12 months, it brought in more than $420 billion in revenue, with net income of about $21 billion and EPS over $23. That kind of consistency is rare. What also adds confidence? Berkshire Hathaway recently invested a very large stake in United Health, which signals institutional belief in UNH's long-term prospects and stability. When one of the most disciplined investors on the planet makes a move like that, it's worth paying attention. Valuation-wise, UNH trades at about 14 to 15 times earnings, a mid-teens multiple that looks quite reasonable for a company with this scale and reliability. Compared to many high-growth tech names, that's cheap. The trade-off is that growth is steady rather than explosive, and regulatory pressures in healthcare are always a risk. But for long-term stability at a fair valuation, United Health is a name worth considering. Number 4, Lennar, ticker LEN. Lennar is one of America's largest home builders, and it has been riding the wave of housing shortages across much of the country. Despite high interest rates, demand for housing remains strong, and Lennar's efficient operations and land bank give it resilience. Earnings have held up well, with profits supported by disciplined cost control and continued sales in undersupplied markets. Here's the kicker. Lennar trades at just 8 to 9 times earnings, a very low PE for a company with positive earnings growth. That valuation reflects investor caution about housing in a high-rate environment, but it also gives margin for safety. If rates ease or demand continues to outpace supply, Lennar could benefit while already priced like a value stock. Risks include interest rate spikes or a housing slowdown, but the valuation is undeniably compelling. Number 3, Bunge Global, ticker BG. Bunge is a global agriculture and food processing company, and agriculture is one of those sectors that often gets ignored until there's a supply shock. Bunge's core business involves trading, processing, and transporting grains and oilseeds, essential goods that are always in demand. It's a stable, global operator with exposure to both developed and emerging markets. Valuation here is where things get interesting. Bunge trades at a PE of about 7x with consistent earnings growth over the past 5 years. That's a very low multiple for a company this size, with demand that tends to hold up across cycles. Risks include commodity price swings and weather disruptions, but as far as value opportunities go, Bunge is about as straightforward as it gets. Number 2, ExxonMobil, ticker XOM. ExxonMobil is one of the world's largest integrated energy companies. It benefits from scale in upstream oil production, downstream refining and chemicals, plus a growing portfolio of low-carbon projects. Over the past few years, Exxon has become more disciplined with capital expenditures, focusing on shareholder returns and debt reduction, while continuing to generate enormous free cash flow. Exxon trades at a forward PE of around 14x, with earnings expected to grow about 20 to 25% this year. That's attractive for a company that pays a strong dividend and has balance sheet strength. Risks are tied to commodity price, oil demand, OPEC policy, and energy transition trends can all shift profitability quickly. But Exxon at a mid-teens multiple, with cash flow this strong, makes it a value worth considering. Number 1, NVIDIA, ticker NVDA. NVIDIA is the undisputed leader in graphics processing and AI hardware. Its GPUs dominate the data center space, powering training and inference for AI models worldwide. In its most recent quarter, NVIDIA reported revenue of $46.7 billion, up 56% year-over-year, with strong margins that reflect both demand and pricing power. Beyond hardware, NVIDIA is building out software ecosystems that could keep its lead defensible. But valuation here is the big question. NVIDIA currently trades at about 50x earnings, with forward estimates closer to the low 30s. That's a premium multiple by any standard. Investors are paying up for leadership in one of the fastest growing tech markets, but it also means there's less room for error if demand slows. For those considering NVIDIA, the strategy may be to start small or wait for pullbacks, since earnings acceleration can still justify its price, but volatility is a given. Let's recap the list. United Health, a stable healthcare giant with institutional backing and fair valuation. Lennar, a home builder priced cautiously despite strong demand. Bunge Global, a quietly undervalued player in agriculture and food. ExxonMobil, an energy powerhouse with cash flow and dividends to match. And Nvidia, the undisputed leader in AI hardware, carrying both massive growth and premium valuation. Each of these companies has strong foundations. Some trade at very attractive valuations while others demand a premium but dominate their industries. None are guaranteed winners, but all are worth a closer look this September. So now it's your turn. Which of these stocks looks most interesting to you right now? Let me know in the comments. I'd love to see how you're thinking about these opportunities. And if you found this video useful, don't forget to hit the like button, subscribe to Seven Hills Equities, and turn on notifications so you never miss an update.